Hi, everybody. Welcome to the June 2026 Economic and Market Update presented by Commonwealth Financial Network. My name is Chris Fasciano, and I am Commonwealth's Chief Market Strategist. Against a backdrop of ongoing negotiations to end the war in the Middle East and a 17% decline in oil prices, may prove to be another strong month for equity investors. Continued strong earnings reports from corporate America help set the tone and provide support to markets despite all the headwinds that consumers and the economy are facing. The Nasdaq, S&P 500, and Dow Jones Industrial Average rallied strongly in May. All three indices closed the month at record highs, illustrating the breadth in the market. First quarter earnings season is over for all intents and purposes, with 96% of index constituents having released their earnings. S&P 500 companies have reported earnings growth of 28.6%. This rate is the strongest growth we have seen in almost 5 years, and more than double the growth rate expected by analysts on March 31st. In even better news, second quarter earnings estimates have increased, and full year 2026 estimates have risen 7.6% since the conflict in the Middle East began on February 28th. This is yet again a strong indication that over the long run, fundamentals drive performance, and that remains a good sign for investors. The Magnificent Seven stocks, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla have continued to put up very impressive earnings growth and are now expected to deliver 37% growth in 2026. But the other 493 names in the index are also now putting up strong growth in their own right. Analysts are expecting 18% growth for these companies this year, after 4% and 10% in 2024 and 2025, respectively. This breadth in earnings should provide a supportive backdrop going forward. On the other side of the portfolio, bonds had a volatile month, selling off in the middle of May due to reports showing accelerating inflation because of the pressure from higher oil prices. However, progress on Middle East settlement talks eased some of the concerns about inflation pressures, and by the end of the month, bonds had recovered and eked out a small gain. The economic updates released last month were mixed, but continued to indicate a growing economy. Not surprisingly, given the recent surge in oil prices, both the Consumer Price Index and the Producer Price Index came in higher than anticipated for the month of April. Consumer prices rose at an annual rate of 3.81%. Even more concerning was the increase in producer prices, which rose 6%. While we are still a long way from inflation reaching the levels seen in 2022, when the Fed reacted by raising interest rates aggressively, this needs to be watched going forward. On the positive front, the April employment report once again came in above economist expectations, with 115,000 jobs created. This followed March's strong 185,000 jobs created. In addition, personal spending also rose for the month, following strong spending data in the previous month. Put together, this indicates the consumers are still in a solid place despite the rise in oil prices. Solid jobs growth and a consumer that continues to spend should buy the Federal Reserve time to wait to see the path for inflation before needing to adjust interest rate policy. This also allows Kevin Warsh time to transition to his new role as chair without needing to immediately react to deteriorating data. Even though risks certainly exist, overall, we remain in a pretty good spot when looking at the economic backdrop and corporate fundamentals, both of which should be supportive of markets. While short-term volatility is certainly possible given the heightened level of uncertainty, the most likely path forward is for continued slow economic growth, strong corporate earnings, and market appreciation over the long term. That's it for this month's update. I'll be back next month to walk through whatever the markets throw our way. Take care, and thanks as always for watching.